The Roth conversion is a powerful tax planning strategy for saving you taxes over the long term. The problem is it's taxable today. Is there anything that you can do to reduce the taxes that you pay on a Roth conversion? I've got some ideas, that and more coming up. Early in my career, I had to deliver some bad news. Yeah, that happens from time to time, but I was meeting with a young professional couple. They were sharp. They had good jobs, and it recently just had a change in their financial life. They were coming in to meet with me, meet with a financial planner to get on the right track, and they were excited. They shared, and to their credit, the Roth hadn't been around for very long, but they had shared that, last year, hey, we did this Roth conversion, and I'm looking at their taxes, and they didn't treat it as taxable income. And I had to share the bad news that, guys, a Roth conversion is taxable. And I'm still saying that they did the right thing, even though it was a surprise and they needed to amend and pay. It was a couple grand of tax that they owed, close to $3 actually, but so painful at the time. I'm still saying, now decades later, they did the right thing. But yeah, Roth conversions, well, over the long term, can be enormously beneficial in saving you and avoiding taxes over the future. I mean, that's like the primary benefit is taxable today, assuming that you're not doing a backdoor Roth strategy, and assuming that, the primary function or mechanics of a Roth conversion is you've contributed pre-tax to an IRA or to a 401k. So you got a deduction on your contributions, and now you're at a spot where you say, you know what, I want to flip these dollars. Instead of growing future taxable, because as you pull them out of your pre-tax account, traditional account, you're going to pay tax on them. I want to move those over to my Roth so that when I pull them out, they'll be tax-free. The growth will be tax-free. I want to move them from my pre-tax, growing taxable, over to my Roth where it's after tax, but growing tax-free. That maneuver is a taxable event, assuming that it's pre-tax money that you're converting. So it's taxable. And, that's part of the deal. That's part of the trade-off. But is there anything that you can do to lessen or reduce the taxes on a Roth conversion? There are. I'm going to share 3 strategies, 3 ideas right now. Let's get the one that you expected out of the way, okay? And this is the one that actually applies to this young professional couple that I met with, and that is doing a Roth conversion when you suddenly find yourself in a lower tax bracket, okay? So this professional couple, the reason why, even without seeking some financial advice and working with the CFP, the reason why they did the Roth conversion the year before is while he was still working, they'd had their first child. And so she only worked part of the year. She didn't go back to work for a chunk of time for the rest of the year after the child was born, and they got the new child tax credit. Now, this is, way back when. I think the credit was $1,000 at the time. It wasn't as big as it is today, but still, they had lower income and they had a new tax credit. So they did a Roth conversion thinking it wasn't taxable, even though it was, but because they were in a lower tax bracket and even had some new tax credits, they were able to capture doing the Roth conversion and pay less taxes on it because it was in a lower than normal tax year. Doing a Roth conversion in any other year when they were both working full-time for the entire year, or maybe doing a Roth conversion before they had the child and the new tax credit, it would have created more tax. So therefore, even though the Roth conversion was taxable, being opportunistic and doing the Roth conversion in a low, maybe uniquely low tax year or income year can reduce the taxes that you pay on the Roth conversion. What are some other times when this may make sense? Maybe near the end of your career, if you're, working through April and then you retire or something like that, or maybe at times when you go from 2 incomes to 1, something like that. Being opportunistic, likely at a time when you're not thinking about tax savings, you're thinking about cash flow in your present financial position, but being aware of uniquely low or some tax valleys, and using those to do Roth conversions to pay less tax, reduce your tax on a Roth conversion than you otherwise would pay. A second way to reduce your taxes on a Roth conversion is being mindful and converting up to tax bracket ceilings or to the floor of a tax deduction phase out. Now, what do I mean by that? If you aren't being sensitive to your current tax situation and what a Roth conversion on top of the rest of your tax situation is going to do, it's very likely that you could miss or overlook that Roth conversion could push you into a higher tax bracket, could introduce new taxes, or limit some deductions that you are receiving. For example, if you switch jobs and you've got an old 401k at your previous employer and you think, yeah, what am I going to, I've got to make a choice with these dollars. I get this question all the time. Should I move them into my Roth? And let's say that you've got 25 grand in your old 401k and you say, yeah, now's the time. Let's just move it over to the Roth. Well, what if adding that $25,000 of income onto your tax return that year moves you out of the 12% tax bracket and puts you into the 22% tax bracket? Well, now you're paying more tax on that Roth conversion than you otherwise would. Instead, if you would have looked and said, you know what? I could convert 15,000 of that 25 right now. That would push me right to the top of the 12% tax bracket. And then I'll do the remaining 10 grand of that Roth conversion in the next tax year, keeping me in the 12% tax bracket both years. That's a way to reduce the taxes on your Roth conversion. Same with a tax deduction or tax credit phase out. American Opportunity Tax Credit. This is one of the very, very frustrating phase outs. If you're familiar with this, if you've got kids in college, you know there's a couple of tax credits at your disposal, and the most beneficial one is the American Opportunity Tax Credit. However, you only get the full tax credit if your income is below certain thresholds, modified adjusted gross income below certain thresholds. And here's the problem, here's the frustrating part. The thresholds have never changed. They have not adjusted with inflation. Therefore, if you're not aware of that or you're not thinking about that transition and you do a Roth conversion and all of a sudden as a married couple, your modified adjusted gross income goes above $160,000, you could limit or reduce or completely eliminate your ability to get the American Opportunity Tax Credit. So, second way to reduce your taxes on a Roth conversion is to ensure that you convert up to the top or the ceiling of a tax bracket so you don't spill over, and up to the floor of a phase out for a tax deduction or a tax credit so that you don't go over that amount and all of a sudden jeopardize some of the benefits that you're getting. And then third, and this is the number one way to reduce the taxes that you pay on a Roth conversion, and that is to combine the Roth conversion strategy with another tax deduction. So this is parlaying two good tax strategies together to make something that's even more beneficial. My favorite, the one that I have done, is doing a Roth conversion while also doing an outsized deduction, maybe to a donor advised fund, outsized charitable deduction, charitable contribution to a donor advised fund. Doing the two of these together would add income to your return via the Roth conversion, but create a new deduction by doing the donor advised fund charitable contribution. Those can offset each other, and voila, you've reduced the tax and maybe even neutralized completely the tax on your Roth conversion. While we've seen some turbulence in the stock market this year, we haven't seen a prolonged decline. So this may seem like a foreign concept, but should you have investments in a non-tax shelter and have some temporary losses, some capital losses in your investments, capturing those losses so that you've got a deductible loss that you can carry onto your return, that can help offset some of the tax and reduce some of the tax on the Roth conversion. And then finally, taking advantage of some of the new but temporary tax deductions that are out there, i.e. the new state and local tax cap that was raised only temporarily from 10 grand to 40 grand. If that now means you're going to itemize your taxes and now you've got a bigger tax deduction, yeah, I mean, you could just enjoy that tax deduction. I get it. Or you could do a Roth conversion because you know this tax deduction is temporary. We have no idea if they'll extend it beyond the 4 years that it was originally passed to apply. And that way you can reduce the tax on the Roth conversion. Same with the new senior deduction, the $6,000 per person deduction that you get if your adjusted gross income is below a certain threshold, $75,000 individual, $150,000 married filing jointly. You get a $6,000 deduction if you are below those income thresholds and are age 65 or older. A lot of folks we helped this year capture that deduction and do a Roth conversion because it reduces the taxes they would otherwise pay on that Roth conversion. Does it make sense for you to implement the tax plan and strategy of a Roth conversion this year, maybe next year, in the near future? And if so, what strategies can you implement in addition to that to reduce the taxes on that conversion? Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.